Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for January the 21st. This is episode 323. I'm Dean Croak, Market Analyst here at DAT, along with co-host Chad Kennedy and special guest Paul Bingham from S&P Global Intelligence. Good morning, gentlemen. How are you?
Morning. Good to be with you.
Yeah, good to have you back, Paul. Been a while.
Yeah.
How's things, Chad?
Things are good. We're just below the freeze line there, and I think we got this cold front moving across the southeast, and northern Florida's bracing for several inches of snow, which they haven't seen in a while. But down here in central Florida, it's in the 50s and raining, so not ideal weather, but doing okay.
I'm coming to you from Bangalore, India, in our DAT office. It's 80 degrees here today. It's absolutely beautiful.
Sounds
it's nice to get away from.
Yeah, so it's getting late for you, Dean.
What's that?
It's getting late for you.
Yeah, it is. Yeah, it's about 8:30 at night. So a little bit of jet lag, but looking forward to bringing Paul back in. Paul, for those that don't know you, can you tell us a little bit about yourself and what you do?
Yeah, so I'm Director of Transportation Consulting in the Global Market Intelligence Division of S&P Global. We are a consulting arm within a very large business-to-business information firm. S&P Global Market Intelligence provides financial business economic data for hundreds of thousands of customers around the world, operating truly globally with headquarters in Lower Manhattan, but employment in offices and customers in dozens of countries, including our largest country of employment, which is India. We have more employees in India than in the United States, where you are. And so within our transportation consulting unit, we provide forecasts and market analysis of primarily North American freight markets, but also international trade, covering all modes of transport and all commodities, with some regional and industry sector level detail for those that need them in both the public and the private sector. We advise organizations that have needs for planning and strategy really across the board, wherever an economist who can do forecasts of some specific commodities or types of freight would be valuable.
Yeah, good. All right. Well, let's dive into the market update. We'll bring you back a little bit later. We want to talk about the new administration, a lot of the executive orders, what's happening on the macro front. That's part of the reason we had Paul on today from a timing perspective. So let's dive into the market update. Let's start with some of the key trends we're watching. Spot rates cooled last week as Blair and Cora, or winter storms Blair and Cora, moved out and Enzo moves in this week. States of emergency in place in the southeast region, so we expect some volatility in that part of the country. Coincidentally, around 60% of single-family homes are built in the southeast where that storm is occurring. Some data from the US Census Bureau came out last week. Single-family home building hit a 10-month high in December, up about 3.3%, which is good news for flatbed carriers. The other news that we're sort of watching, and that's the demand really cooled off in what would normally be peak season in November and December. A couple of data points we watch. Jason Miller's truckload ton mile index was down slightly, down about 0.5 percentage point month over month. It's down almost 1% year over year. Cass was down more than we thought, about 7.3% in November. It's sitting about 6.5% down year over year. Bob Costello's ATA tonnage index also down 2% in December and down about 1% year over year. So there's three key data points in the truckload space that were all down in what would normally be peak season as we head into Q1, which is also notoriously a slow freight market. Of course, Inauguration Day was yesterday, changes in the air. We'll bring Paul back a little bit later to discuss the implications. A lot of the market update you'll hear on this show will be published this evening on dat.com/market update. In this week's edition, we're looking at winter tyres and how best to manage cold weather. A little bit on December's Logistics Managers Index, a piece on avocado shipments for reefer carriers ahead of Super Bowl, and the latest steel production numbers from S&P Platts. All right, so let's dive into the market update with our load-to-truck ratio in dry van. There was some stabilization in the market last week as capacity started to move following the larger storms. The load-to-truck ratio in dry van ended the week at 7.76. In the refrigerated market, load posts were down last week and sitting at about 21% lower than last year. The produce market is putting a little bit of a drag on reefer volumes. They're down year over year by about the same volume. Directionally, volumes are on track to continue declining until we get into spring. So no surprise there in some of the cooling in the load post section. Load to truck ratio last week ended the week at 11.43. And in flatbed, even though load post volumes were about 8% higher than the prior week and about 17% higher than the same week last year, they're within about 6% of the long-term average for week 3 of the shipping year. So some good news there for flatbedders. Load to truck ratio ended the week up by about 4% at 27.41. Having a look at our year-over-year look at spot rates in dry van line haul rate, this is the average 7-day rolling average, ended the week at $1.81. It was down 3 cents a mile. It erased most of the prior week's gains caused by the coal snap. At $1.81, they're about 9 cents a mile higher than last year. In the refrigerated market, rates cooled last week. They were down 5 cents a mile to a national average of $2.16. Compared to last year, they're about 4 cents a mile higher, or about 2%. In the flatbed market, capacity eased last week. They're down about a penny per mile to a national average of 203. Remember, folks, these are excluding fuel, so these are line haul only. Spot rates are about 3 cents a mile higher than in week 3 of 2024, 8 cents a mile higher than where they were in 2018, and identical to where they were in 2019. Let's have a quick look at our forecasts. Let's start off with dry van. These are our short-term forecasts, over 550 miles excluding fuel. The blue is the 7-day rolling average. The green is rate cast out to this time's going out to February 20. The upper and lower bands are in amber and red. In dry van, spot rates are looking to be down about 4 cents a mile nationally to $1.76 by the time we get to the middle of February. Low case scenario has rates down 11. High case has rates up about 4 cents a mile, which is fairly optimistic. And I actually think given where we are and the volatility we're seeing in the market right now and tightening capacity in some of the regions driven by weather, the higher case scenario may be where we think rates are going to end. In the refrigerated market, Ratecast is looking for rates to continue sliding down about 12 cents a mile to 203. Again, that's no surprise. We normally see rates head this direction. Low case has rates down 19 cents a mile, high case down 5 cents a mile. But again, a lot of seasonality here before we get into April and spring produce season. Flatbed, pretty good forecast for flatbedders. Flatbed rates looking to be pretty flat out to February 20 at about 201 a mile. Low case scenario has rates down 5, high case up 5. So flatbed is starting the year pretty much like it did in 2023 and 2024. Relatively flat throughout the course of the year when you look at the whole year in totality. So that's our forecast for this week. I'd like to bring Chad back in now to talk a little bit about what he's seeing in the contract market.
Yeah, thanks, Dean. So everything I'll cover here will be from the shipper buy perspective. So shippers buying from carriers and brokers, starting out with our van spot versus contract year-over-year index. So this is monthly van spot and contract rates. Spot are in red there. Contract rates, and it's year-over-year since 2017 on a percentage change basis. So spot has been up year-over-year since June 2024, and contract rates just around 0 to just below -1% since November. So we're starting to see that cross the 0% line. And that the mix between these two is about 17% spot currently over the last 4 weeks. And we've seen, as we've talked about in prior episodes, we've seen that a little bit higher than prior soft cycles, shippers utilizing spot a little bit more than they used to, even in soft cycles. And then down here at the bottom, I just have some annual inflation, deflation rates. So you can see 2024 rounded out the year at -4%. This is all rates included. So everything that a shipper is buying, spot, contract, the mix of those and the rate change, -4% deflation. After 2023, a -15%. So this has been the best 2 years running for shippers, and I think probably ever, especially in the dry van market. Let's go on to reefer. Reefer rates, that contract rate year over year, hugging 0% since October. So spot has been up year over year since June and July. And this is consistent with what we're hearing from shippers, both on the van and reefer rates, is that they're holding bids, they're getting mixed results back. Some are taking slight increases, some slight decreases. And again, it all kind of depends on where you started from, how long it's been since you've had a bid, that sort of thing. And the mix for shippers on reefer of spot is about 16%. And then down there at the bottom, you can see the annual inflation rates, -4% there for reefer for 2024 after 10% in 2023. And we'll wrap up here with flatbed and then intermodal. So flatbed rates here, they've been hugging 0% as well, not quite over 0 yet. So even some slight trend down from a year-over-year perspective there in blue over the last few months. So not the trend we're seeing on reefer and dry van. Spot rates did take a slight tick up there year-over-year at the end of Q4. And then you can see the year-over-year, a little less volatility, interestingly, on an annual perspective, only 3% deflation after 6% the prior year in 2023. I say that interestingly because when you look at our flatbed data, because those lanes are so seasonal, there's quite a bit of volatility. But when you aggregate it up, these are the results. And then let's wrap up with intermodal, just showing contract here. Don't have a significant amount of spot intermodal data to report on here. But you see that little tick down there at the end of the year. Just want to call out, that's a small slice of our January data so far. So I wouldn't hold too fast to that. I'm probably going to flatten out as we get the rest of our January data contributed and reported out here. And you can see those annual numbers there, -5% for the year for intermodal after -4 last year. So that's a wrap on the contract rates.
Hey, Chad, with bid season sort of in the rear vision mirror, when do you expect some observable impact on our rates as we get to, how rates compare year over year as new rates start to come into routing guides?
Yeah, March, April will be very telling. So the bid season is the administrative work of bidding that happens from about October through December. There's quite, with these very large bids, especially in the CPG world, which is a large portion of the freight out there. So those will start to execute March, April. That's when we see the bulk of the new rates come in. So it'll be very interesting to see how those come in. We do run some surveys with our shippers. What they're telling us is what I mentioned earlier, some mixed results, some increases, some decreases. We're not expecting a massive change come March, April. I think when produce season starts to pick up, it will be interesting how that spot market responds to give us a sense of what capacity is really like and see how rates are going to play out for the rest of the year.
Yeah. Eagerly awaiting Vidalia Onion Pack Dates. And I guess the Plant City Strawberry Festival where you are, that's going to be the key to see how Florida season starts off.
Yeah. Backs up I-4 traffic for about a month. Yeah,
they have some of the best hot dogs in the world at that fair. I've been there a couple of times. Anyway, let's bring Paul back in. I'm excited to have you with us, Paul. Question of the week. Now the new administration is in and we've got some executive orders. What are the sort of things you're watching as it relates to logistics, supply chains, and macroeconomics?
Well, thank you, Dean. It's great to be back. A great timing. So the president out the doors, an enormous slew of executive orders and actions, as was anticipated yesterday. However, for us, looking at the freight logistics side, we were first interested in what was going to happen with tariffs, and in fact, he talked about them, but he said, "Well, next week." We didn't get the day one, tariff slapped right on immediately. He's talking February 1st. And importantly, sort of waiting for that shoe to drop, but it was 25% on Canada, Mexico. So our top two trade partners across the board, 25% import tariffs. We're watching very closely the details that are going to follow. What else from what had been speculated during the campaign season regarding tariffs we're going to see actually imposed by the administration. And very importantly, that follows on this quickly, especially for certain segments of the U.S. economy and freight, what retaliatory tariffs are we going to see imposed on U.S. exporters that then affect some of our producers that move freight to the borders? But that's not all we're looking at. We're also looking at some of the other policies. He moved very quickly on some of the immigration front, and there are macroeconomic and ultimately demand factors that come from immigration in ways we don't always think of first. But for example, employment, there is employment of those, whether they're here legally or not. That contributes to the workforce, that contributes to production. It also contributes to consumption.
Hmm.
And in the past few years, as that has grown massively, that has been an element of the U.S. economy in terms of strength, both in terms of total, work hours available, whether or not they're under the table and actually being done legitimately, or on the consumption side in terms of residents that are here illegally or not, consuming and providing some demand. And
Hmm.
obviously that can be an influence that can affect the economy as well, not as substantially as we may see from the tariff issue. And let me go back and follow up quickly on the tariff issue a little bit more. One of the reasons we're concerned with that is the inflationary impacts of tariffs. And we've already incorporated some assumptions in our updated macroeconomic forecast that this will have an influence on inflation. And
Hmm.
inflation then affects the central bank, the Federal Reserve Board's less reductions in interest rates, which then will affect other factors of demand in the economy, both cost of capital for those that would be making investments, and for consumers trying to take out loans for whatever it would be, or financing their credit card debt. That being potentially a little bit higher interest rates than would have been a baseline without tariffs and without the Federal Reserve Board slowing their easing likely in 2025. So there's some big factors at work. Some of them are not instantaneous, but overall, this has resulted already in our macroeconomic forecast, the top level gross domestic product, biggest picture view of the economy. We're now forecasting a 1.98% growth for 2025. This is following on what we saw. We believe the final numbers will come out to be close to 2.75% growth in the U.S. economy in 2024. So we're talking about overall a slowing economy
Hmm.
in 2025, and that has repercussions for demand growth. There's some other pieces in that are sort of a silver lining. We actually still have growth industrial production coming up from off the floor of being, less than 0.5% to being slightly over 1%. This is by no means any kind of toward growth, but a slight tick upwards in overall industrial production anticipated even in that context in 2025, which will help for some of the industrial freight demand. But by no means are we back to what you would consider, a strong freight economy quickly
Hmm.
as we get into 2025 with some of these headwinds and what we're forecasting right now.
Yeah.
Paul, with the tariffs that are getting floated, and I kind of pick up on the sense that there's certainly some negotiation tactics going on here with the 25% number of Mexico, and probably won't end up with that number. And I don't know what the final number would be. I'd be interested to hear if you have a probability on that number, if it's 12% or 10%. I'm curious, could you just step us through some of the implications of that? If there were a 25% implication tax tariff, how does that impact manufacturing in the U.S.?
Mm-hmm.
Does it shift manufacturing? I assume there's some short-term, long-term implications that are probably a little bit different.
Yeah, that's a very important perspective. And let me start with the imports tariffs act as a tax. Um, And for the United States, if we oppose them on Mexico and Canada, it's those goods coming across the border, whatever they are. That includes things like crude oil from Canada. So we're not all talking about rail and truck here. I mean, there's other commodities that move. And in
Mm-hmm.
fact, that's the biggest volume one from
Mm-hmm.
Canada. Not so Mexico, where it's manufactured goods. But those tariffs affect intermediate goods. And for lack of a better assumption, right now, our macroeconomic model used an assumption of a 10% across
Okay.
the board, not just Canada and Mexico import tariff, effective in the second quarter, not in February. So we may find the timing of that, is yet to be determined. But importantly, what happens in the near term is you face that import tax is immediate. It raises prices if the producers in the foreign country that you're trading with don't absorb by lowering their nominal prices that tariff. It's a tariff that carries through ultimately through retail competition to what you pay for those goods. And for goods where there's really, not a lot of margin reduction to squeeze on the wholesale side, that could result in a 25% inflation on that particular commodity, whatever it is you're buying.
Mhm.
Um, but there are substitutes in some cases. In the commodities where there are substitutes, you may choose to buy, say, a domestic beer rather than a Mexican beer, and therefore,
Mhm.
maybe escape some of that. And there, those kind of shifts can then they can act as a boost to domestic demand and help some domestic producers. We saw that during the first Trump administration for some commodities, like some of the metals that were tariffed fairly heavily, where there was a shift towards domestic production that helped some of the employment and the producers in that particular sheltered sector. It's harder to see that happening so strongly across the board, and the cost of that is for the intermediates. If you think of all the companies that are buying imported parts or imported components or imported materials, or even something like the crude oil coming in. That's going to tend to, if you tax that 25%, that's a substantial amount of Canadian crude that comes into the U.S. that ends up in the pump prices that we're all paying. Whatever that is, distillate or motor gasoline. For truckers, they're going to face some upward pressure there because that crude oil cost has gone up. And those are all fairly near term in the sense that they would happen in 2025. Longer term, there are also, if those tariffs are permanent, they change the competitiveness situation of the U.S. versus those trade partner economies. And that's, I think, a lot of times what the advocates within the Trump administration of the tariff policies are saying is that ultimately it's a boost for sheltering the domestic producers from some of that foreign competition, and you would have a higher than baseline employment and production in those commodities where that cost differential would be enough to move some of that production onshore. And that would be part of the result. Whether on net you're better off as an economy is really more of an open question, depending upon what commodities are tariffed and at what rates and what timing. And then there's always the waivers and the exemptions that we saw, for example, in the first Trump administration. So there's a lot of details to be worked out to see whether your part of the economy is going to be affected. And if I'm in trucking, which segment I'm serving. Am
Right.
I hauling imported furniture, or am I just worried about diesel prices because I'm already domestically focused?
Mm.
It's amazing how complicated it is to wrap your mind around all the implications. You touched on energy. So there's a tariff implication potentially on energy. And I think there was also an executive order signed about an energy state of emergency to increase production domestically. And then I think, Dean, we were talking earlier about the Houthis agreeing to some peace agreements. How does that all play into fuel prices at diesel pumps for truck drivers in the long run?
Well, the increase in production, longer term for any consumer is a good news story. If
Mm-hmm.
indeed the government is able to encourage, they're actually not doing the drilling. It depends on the companies and all their suppliers. Importantly, we think of like
Mm-hmm.
flatbed benefits in some sectors from increases in drilling activity. If that increased production goes to export, is the U.S. net better off? It depends, really. If we're successful in expanding production, that's good news for the producers. For the consumers, it depends sort of how much of that supply ends up in a U.S. market. If at the same time we're restricting some imports through tariffs, so we get back to sort of that net equation of are we better off on net from having higher energy production within the U.S. I think the consensus is likely to be the combination of the regulatory and the other steps being taken to encourage production is that would be positive, but it really is going to depend on that tariff story
Mm-hmm.
because the U.S., you know, even though we are an enormous energy exporter, we're still importing some energy products, and therefore, we are still susceptible to the competition globally. It also affects what happens overseas. So, as you mentioned, the Houthis, the ability to have the Suez Canal route in the Middle East reopened to commercial traffic, and it's really in the end sort of perversely an economic decision. You think, well, why is that? Well, it's because in the end, you have to have insurance to run your vessels through those high risk areas. And the cost of that insurance is coming from underwriters who are judging the likelihood of loss and damage to a vessel they're going to insure. So the probabilities around those attacks matter. And that's really in the end going to determine whether that route to that enormous distance and time savings and therefore cost savings route becomes back available to the global shipping community, and whether then that's going to affect markets across the board in terms of commodities and vessel capacity and activity globally, as it affected negatively with the start of that that closure of the Suez, more than a year ago now.
Mm. Paul, we we had some changes to the tax code in 2018 that sort of drove part of that freight economy. We had a pretty robust industrial economy coming out of 17, and then of course we had some freight recessionary activity, and according to research, partly driven by the tariffs that were put on in 2018. Do you see any similarities with how the freight market is going to look for the rest of this year if we do in fact have another round of tariffs and it becomes sort of they are inflationary, as you've said, and that impacts the freight market? Are there similarities between the two cycles, do you think?
There are similarities, though I think what we're considering might happen this time has a broader scope. In fact, has the potential to have a greater impact overall in the goods consumption markets, which then ultimately is the driver of the freight demand, apart from sort of the industrial production, resource extraction part of the economy. And as of our current estimates, with the assumptions we've taken, we are actually forecasting continued growth in consumer demand. However, at a slower pace than we saw already under the freight recession in 2024. In fact, it's a substantial downgrade in the percentage growth. We have estimated that growth in the sort of consumer side of the good side of the consumption of the economy was growing over 5% in 2024, even with what you can see as the freight recession because of such factors as the weakness of industrial production. But we're forecasting that consumer demand to growth to slow to 2.7% as a result of the combination of factors that we're now taking into account, in advance of getting some of the details. But there's clearly a risk to some freight demand from that higher inflation and what would follow from that in terms of the interest rates that we face in business, the cost of capital, and especially consumer demand. If we layer on inflation, that back in that first Trump administration, we didn't face those same levels of price inflation.
Exactly.
And for certain income cohorts, it's already affected their consumption behavior substantially. And if you put on more inflation on top of that, you can anticipate, those cohorts in terms of consumer spending will be even more pressed in terms of their ability to continue to consume at the paces that we saw during the pandemic, which are, long behind us now.
Right. Was there any change or mentioned change to the corporate tax code that might stimulate investment?
Yes, in fact, that's one of the questions that we didn't hear yesterday. We are assuming that between Congress and the Trump administration, that those expiring tax cuts, of which we are facing later this year, if Congress does nothing, some of those tax rates go up because the reductions that were put into place back at the time that those tax relief acts were passed will expire. So it depends on Congress to either extend those or perhaps change them in some way. And there were lots of things said about taxes on the campaign trail that we're not sure how they're going to play out, and that includes even income taxes and other specially targeted industry tax rates adjustments. And between Congress and the administration, we'll have to see what actually comes from that. But there is some potential for actual additional tax relief for certain sectors that would boost those, at least the financial prospects, if not the demand side for those sectors of the economy. So this is a complicated policy change situation where you have some stimulative actions on the part of the Congress and the administration, quite possible, which would have some potentially substantial impact alone. However, in the face of perhaps increasing inflation and interest rates not as low as they could be. So we're in a situation where there are both what you would consider, that increase in tariffs, which is in some ways is essentially an increase in a tax, being offset by other tax reductions or continuations of tax reductions that we've had. And it's going to be the combination and the timing of those, how quickly that happens and plays out, and when businesses or consumers benefit or face the consequences of that, which will shape what we see as the overall demand situation in 2025. It's not all happening this week. It's going to take some time to play out.
Paul, could you share with us what you know about the Panama Canal? I know Trump mentioned that we're going to take it back. I'm not sure exactly what that means, and I don't know what the implications of that are.
That is really a mystery in terms of how that would happen. I mean, we signed as a country a treaty back. In fact, it was Jimmy Carter, who recently passed, who signed that treaty, and we handed over the canal in 1999. The Panamanians made a huge capital investment to expand the canal starting in 2016. That was not paid for by the U.S. taxpayer. That was a Panamanian government decision, and it's their asset. We did not build that. That was under the Panamanians. So from a U.S. perspective, the Panamanians run and operate and own the canal, and have, for 25 years quite successfully in terms of its performance. Now they face some real weather challenges, where we saw the low water and problems with the capacity reductions in 2024. And they're taking some steps to try to alleviate that. It's not clear, at what expense and what timing that can fully happen. But as far as the United States government trying to take control of that, I don't know how that actually works. I mean, the U.S. invaded Panama in 1989 when Manuel Noriega was in power. Very briefly, and otherwise out of the canal zone at the time, did not extend that to try and take control of the country. I just don't really understand how that would work. It's not incorrect to say that the Panama Canal primarily is serving North American, if not the U.S. market, in terms of the majority of the vessel transits and the tonnage and the commodities that physically move through the canal are tied to the U.S. economy. That's correct. That's probably why the U.S. government helped get it built, more than 100 years ago. But having said that, it's under the treaty, it serves all nations, and the Panamanians have been very strict in adhering to that neutrality in terms of what vessels transit. And really, it's what you pay to go through, and it's not inexpensive to operate that system. And they charge tolls appropriately. The U.S. government charged tolls all the years that they operated it, no matter how large or small you were that went through it. So you can argue about what toll rates should be. The Panamanians have an open and transparent process in setting those toll rates, and they're market sensitive. They talk to the vessel operators that ultimately are those that decide whether or not to use the canal or go on a bypass route. So I think I don't know more than that, other than it's important to the U.S. economy. If it's not operating, it's going to raise shipping costs. It affects trade competitiveness, and strategically for the United States, it's still an important connection between the Atlantic and Pacific Oceans, and for the entire world, that route being available.
And what is China's role there?
China right now there are two container terminals at both the Atlantic and Pacific side of the Panama Canal, for which a Canadian stevedoring company has the lease. So there is a Chinese controlled company that is operating a container terminal at either end of the canal. And those are operated by Panamanian citizens who are, mostly with some management employment of that company. And that's the extent of the Chinese involvement in the operation of the canal. In fact, that's really not the operation of the canal. It's container terminals that happen to coexist with the vessel traffic that's going to and from the canal, en route. Is really what is today the China involvement in the canal, if you can say that. Now, there are Chinese vessels that pay tolls to go through, just like every country that's sending. So that you can argue that some of the revenue that the Panamanians are receiving is from Chinese-controlled companies. Oftentimes, though, what is filling those Chinese container ships are goods that are owned by beneficial cargo owners that are importing them or exporting them out of the U.S. So. Sure. Even that's hard to say, okay, that's just being used by China.
Paul, while we're on the topic of ports, any thoughts on the new 6-year agreement that's yet to be ratified with the ILA on the Eastern Gulf Coast?
Well, we were very, very thankful to see that we did not suffer a second strike back on the 15th of January,
Mm.
and have a resolution. The terms of that agreement, with quite a substantial increase in compensation, and then the agreements on limitations on automation of the terminals at that
Mm.
ports, potentially has longer term competitive implications for port container terminals, especially that from a global perspective face some challenges being world class in terms of the ability of companies to invest in automation, which has existed, in some cases for 20 years in some overseas ports. But at the same time, you have very professional, skilled labor that's guaranteed to continue to work, and within the work rules and the constraints of those terminals, you have labor that's moving record volumes of cargo in some recent years and doing so successfully. So
Mm.
I be clear that this is not a job that somebody just shows up off the street and does day one. It takes some
Right.
substantial skill sets, and especially when we're not using automation, you want very skilled professional employees
That's a
doing
good
that.
point.
And,
Mm.
and that's true, not just for the East and Gulf Coast ports. That was true for the West Coast ports, where the year earlier we had a West Coast
Mm.
coastwise longshore agreement. So from a shipper perspective, in some ways, what's good news is likely labor stability now,
Mm.
for several years. It's very unlikely we're going to face the same threats of disruptions, and it's very likely that these port terminals are going to be operating, as productively as they can be now for several years without any disruption. And the shippers and the logistics operators will be able to count on that. That there's
Mm.
unlikely to be labor disruptions now for the length of this contract. Once it's finally ratified with some retroactive timing on it. And in some ways, always as a supply chain manager, that certainty is a good thing and
Mm.
actually has some real monetary value for you. So having certainty of the labor situation for all of the U.S. Container ports on the east and west coast is a positive as we go forward for the next several years.
Yeah, great point for our shippers. Paul, before we wrap up the show, how can people get in contact with you?
The best place is on our either via our website, which is spglobal.com, or my own email address is paul.bingham, paul.bingham @spglobal.com, as you can see in the logo behind my head here. That's on the screen for those of you watching.
Great. Well, thanks for being on the show. A couple of shout outs. On the Freightvine podcast, Professor Kaplis is talking to Ian Jeffries. He's president and CEO of the Association of American Railroads. They're talking about the 2022 railroad dispute, the long-term effects from that, and how the railroad industry is currently evolving. On next week's show, we have Dan Deegan of Logistics Life fame. The podcast comes out of Canada. Dan's also a 3PL expert on the north side of the border. I'll be on Radio Nemo with Jimmy Mack this Thursday morning, 8 a.m. Eastern. As always, make sure you set up alerts for our show, subscribe to our channel on YouTube. And with that, another show is in the books. Thank you for watching. Be safe, be nice to everyone. We'll see you back here next week at 10 a.m. Eastern, 7 a.m. Pacific.